US stocks have fallen sharply on weak earnings from Tesla and other tech stocks. The Bank of Canada cuts again. A surging yen is pushing the US dollar down, and the Aussie and Kiwi dollars are being caught in that downdraft as well. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ's chief economist for Greater China, Raymond Yung, explains what needs to happen to revive domestic demand as Chinese consumers refuse to spend more, despite looser monetary policy.
The government needs to introduce more spending to offset the weakness of the private sector in order to lift aggregate demand.
But first, in 5 and 5 with ANZ, the S&P 500 was down 1.8% and the Nasdaq down 2.9% at 4 a.m. Sydney Melbourne time, as investors reacted to poor earnings reports from Tesla and other tech stocks. US PMI data overnight was also mixed as manufacturing slowed. Meanwhile, the Bank of Canada cut rates for a second time, citing economic headwinds. Here's ANZ economist Bansi Madhavani.
The governor said that it is reasonable to expect further interest rate cuts and that they will be taking decisions in a data-dependent, one-at-a-time way. The good news is that conditions for the much-hoped soft landing seems to be unfolding in Canada, and the hope is that this becomes a common theme across other regions, especially the US.
Bansi says attention now turns to the US second quarter GDP and core PCE price index data tonight. Annualised growth is likely to lift to 2% from 1.4% in the first quarter.
Now that is a sequential improvement, but for the first half of the year, growth remains close to its potential rate. That is exactly the Goldilocks scenario that the Fed would be hoping for. Our view is that the macroeconomic conditions are falling in place for the Fed to begin cutting rates in September.
The US dollar index was down 0.2%. Despite that, the Aussie dollar was down 0.35% at 65.91 US cents, and the Kiwi was down 0.34% at 59.38. Number 2. One reason for that weaker US dollar, as well as the weaker Aussie and Kiwi, is a surging yen. The dollar fell 1.2% to 153.7 yen overnight, after earlier breaking through the key 155 level. ANZ head of FX research Marja bin Zaman says carry trades are being unwound on a stronger growth outlook ahead of the Bank of Japan meeting next week.
Services PMI in Japan did come out to show an improving outlook, rising to 53.9 from 49.4 in June, indicating that growth in Japan is still holding up. Services input prices also increased along with the other inflation indicators, including CPI and PPI, providing some comfort to the BOJ to consider raising rates at their meeting next week. Market expectations are currently pricing in around a 60% probability of a rate hike in July, with around 22 basis points of hikes priced in for 2024.
Number 3. Australia's July composite PMI fell slightly, with stronger services offset by ongoing weakness in manufacturing. ANZ economist Maddie Dunk says the Reserve Bank of Australia is watching business indicators like the PMI closely. And while those are weakening, second quarter inflation data next week might come in above the RBA's forecast.
I think one of the things is that there has been this dichotomy between what's happening on the activity side of the economy and what's happening with the inflation data. Generally, we're seeing that activity in the Australian economy is slowing. You can see that in the NAB business survey, in the PMIs, in consumer spending. On the other hand, though, inflation still looks quite sticky. So that's the conundrum that the RBA are going to be dealing with at their August meeting.
Number 4. Malaysia's annual June CPI came in at 2%. It was below the 2.2% consensus expectation. Core inflation stayed at 1.9%. ANZ economist Arindam Chakraborty says the PM in Malaysia has said the petrol subsidy removal remains off the table for now, something that would have driven prices up further.
The government wants to make sure that the implementation of targeted diesel subsidies is fully understood by the public. This implies that inflation will remain broadly stable in the coming months, as we do not expect any significant second-round effects of the diesel subsidy rationalization. Therefore, we don't see the need for any monetary policy action by Bank Negara Malaysia.
Number 5. South Korea releases its second quarter GDP figures today. ANZ economist Crystal Tan is expecting flat quarterly growth, with the annual rate falling from 3.3% to 2.5% because of weakening domestic demand, something the Bank of Korea will be watching for closely.
The composition of growth will also matter. If domestic demand weakens more sharply than anticipated, that's going to strengthen the case for moving away from a restrictive monetary policy setting sooner rather than later. But for now, our base case is still for the Bank of Korea to pivot in October.
Crystal tan there. Now, in our bonus deep dive interview, ANZ Chief Economist for Greater China, Raymond Yung, explains the economic theory behind China's liquidity trap. That's where households aren't spending despite monetary policy easing. And that requires fiscal policy to step in to boost demand.
The whole idea is that an equilibrium situation of an economy, then we really need to have a clearance or market clearing in the goods market. We call this the IS curve, and the money market, which is the LM curve. We can also have an open economy version of this, bringing in a BP curve. All these curves, they overlap together, then we find the general equilibrium, of the economy. Now, in terms of liquidity trap, we can frame this graphically to present this idea as a very, very flat LM curve, which means the right shifting of the LM curve will not help boosting or bring the economy back to full employment or expansion of output. So I believe that now, that by given what we have observed in the past few years with successive reduction of interest rate, with the injection of credit to the economy, with the relaxation of the mortgage requirement, we haven't seen, a recovery of domestic demand or property demand. And if China had already or has started the footstep of Japan's last decade, then we clearly see that this interest rate policy will not be effective. And that's exactly what we have observed in the last 2 years. So with a very flat LM curve, in this type of situation, then China really need to have a very, very bold fiscal policy, which means that the government needs to introduce more spending to offset the weakness of the private sector in order to lift aggregate demand. So hopefully the intensity of the fiscal policy will be big enough, large enough to escape from this liquidity trap so that the curve will be back to the positive sloping region of the LM curve. And by then we will have a more effective fiscal policy, and also the monetary policy will be able to be executed in this type of situation.
Yeah, could you explain for an audience outside China why households seem so reluctant to spend money and actually hoard a lot of cash? They put a lot of their savings, into the bank. Why won't they take it out and go on a buying spree?
That is the household hoarding of cash. With now the household deposit in China is already more than 140 trillion RMB, record high, according to the latest number by the central banks, suggest that China is already in a liquidity trap, which means that people are very cautious in spending, and whatever monetary policy or monetary injection to the banking system, I got the cash, but I don't really want to spend money, and that reflects a high marginal propensity to consume. And even if the fiscal policy wanted to increase or subsidize household to spend money, effectively this increased the real income to them, but then they are still very cautious. That has something to do with how they expect the economic prospect. If they feel the economy is very uncertain, the outlook's very uncertain, then this will result in a very, very high marginal propensity to consume, or low marginal propensities to consume, a very high marginal propensity to save. Now, technically speaking, this will also be reducing the effectiveness of government spending in a way that the fiscal policy will be less effective. Graphically speaking, if you read my notes, it means that a steepening of the IS curve. So in this type of situation, I think not only China need to increase the fiscal intensity, but fundamentally what they really need to do is to have some sort of micro level reform so that the incentive system at the very micro level, including corporate and household, will be incentivized more effectively to boost the fiscal policy effectiveness.
Raymond Yung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, July the 25th. Catch you tomorrow with a look at what that US second quarter GDP and PCE data could mean for the Fed's rate cut path. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.